Hello everyone and welcome to my channel, Compliance Lookup. In this video, we will be learn about transaction monitoring and reporting. If you have not watched earlier lecture of country risk, then watch it first. These topics are essential for financial security and this will be covered in three parts. As this is the last chapter in anti-money laundering and part A, then we start know your customer. If you found this video helpful, don't forget to like, share and subscribe for more content on financial compliance, regulations, and more. Reporting obligations of banks. Now, let's understand what this is. Transaction monitoring ensures banks detect and report suspicious activities under various legal and regulatory frameworks, preventing money laundering and financing of terrorism. Banks must follow the Prevention of Money Laundering Act, Prevention of Money Laundering rules, and guidelines issued by the Reserve Bank of India. Let's break down the obligations and guidelines with real life examples. 1. Reporting obligations of banks. Banks are obligated to monitor customer transactions and report any suspicious or high value activities. Now let's divide into broad. First, PMLR stipulations. First, CTR cash transaction report. Banks must file a report when cash transactions exceed Rs 10 lakh in a day, either from a single customer or across multiple linked accounts. Example: a construction contractor deposits Rs 15 lakh in cash into their account in one day. As this amount exceeds the threshold, the bank files a CTR with the Financial Intelligence Unit India to track large cash movements and prevent potential money laundering. Second is STR suspicious transaction report any transaction that seems unusual, inconsistent with the customer's known profile, or has no clear purpose should be reported. STRs help flag potential illegal activities. Example: a student who typically transfers small amounts between accounts suddenly transfers Rs 5 lakh to an offshore entity. This unexpected behavior is flagged by the bank's internal systems, leading to an STR being filed with Financial Intelligence Unit India. Investigations reveal ties to a money laundering network. Third is CCR Counterfeit Currency Report. Banks must report any detection of counterfeit currency during deposits or withdrawals. Example: a customer deposits 50,000 rupees at a bank branch and during routine checks, the bank teller finds that rupees 2000 and rupees 500 notes are counterfeit. The bank immediately reports this using the CCR, helping authorities trace the source of counterfeit money. Fourth, delays and non or improper submission delayed, incorrect or non-submission of reports can result in penalties. Banks need to maintain accuracy and timeliness in submitting these reports. Example: in 2020, the RBI penalized several banks for late filing of STRs and CTRs. One bank had detected a series of high-value suspicious transactions but delayed the filing, enabling criminals to move the funds abroad before authorities could act. Fifth, proper internal mechanism. Banks are required to have robust internal systems such as transaction monitoring software that alerts staff to suspicious activities, employee training to identify suspicious behavior, manual escalation processes for high-risk cases. Example: a bank uses an automated system that triggers an alert when a dormant account suddenly has large transactions. A customer who hadn't used their account for years suddenly deposited Rs 20 lakh in cash and initiated several online transfers. The bank's compliance team investigated and filed an STR based on the findings. Next B. RBI guidelines. The RBI has set specific guidelines for banks to ensure reporting is timely, accurate, and comprehensive. Let divide it broad. First is suspicious transaction report STRs. Banks must submit STRs whenever they suspect that a customer's funds might be linked to illegal activities. Example: in 2017, an Indian bank noticed that a customer with a modest income was regularly wiring money to accounts in tax havens. After filing an STR, An investigation revealed that the customer was a middleman in a money laundering scheme funneling money through shell companies. Now, second, Counterfeit Currency Report SCCRs. Whenever counterfeit currency is detected during transactions, banks must immediately report the incident using the CCR format. Example: in 2022, a teller detected fake rupees 500 notes during a cash deposit of rupees 1 lakh by a local business owner. The bank immediately filed a CCR, helping law enforcement track a larger counterfeit currency operation targeting banks. Coming to third, non-profit organization transaction report (NTR). Non-profit organizations are often vulnerable to exploitation for money laundering and terrorist financing. Banks must report NPO transactions annually or when they exceed specified thresholds. Example: a charity organization received a rupee 30 lakh donation from a foreign entity, which was the bank flagged the transaction and reported it under NTR. Investigations found links to international terror financing. Now, fourth, cross-border wire transfer report CBWTRs. All cross-border wire transfers above rupees 5 lakhs must be reported. This helps track illicit international fund movements. Example: a small business in India sent rupees 25 lakh to a company in a foreign jurisdiction known for financial secrecy. The bank filed a CBWTR because the transaction raised red flags for potential tax evasion or money laundering. Further review showed the company was under investigation for laundering funds via cross-venture payments. Key takeaways: reports like CTR, STR, CCR, NTR, and CBWTR are mandatory for banks under both PMLA, MLR, and RBI guidelines. Delays and improper reporting can lead to penalties, and real life cases demonstrate the consequences of non-compliance. Real life examples of suspicious transactions, counterfeit currency, and cross-border transfers highlight the importance of timely reporting to detect and prevent illegal financial activities. Now, coming to new topic, salient aspects of reporting, FIU guidelines. Financial institutions need to report certain transactions to the Financial Intelligence Unit under different categories based on the nature of the transaction. Let's understand the major reporting mechanisms with examples. A. Nature of FE report. First, rule-based threshold value. Financial institutions are required to report transactions that cross certain threshold values. Example: if a person deposits 10 lakh rupees or more in cash in one day, the bank must report this transaction to FIU under the cash transaction report. Even if the person deposits 4 lakh rupees in the morning and rupees 6 lakh in the afternoon at different branches, the total is still 10 lakh rupees and the bank will file a CTR. Second, rule-based event of counterfeiter notes. Institutions must report incidents where counterfeit currency or forged securities are detected. Example: a customer comes to deposit rupees 2 lakh, but upon verification, rupees 50,000 worth of counterfeit rupees 500 notes are detected. The bank is required to file a counterfeit currency report to the FIU detailing the incident. Third, norm-based judgment of genuineness. In cases where transactions do not meet specific thresholds but still appear suspicious, financial institutions use their judgment to report them. Example: a customer with a long-standing account and low balance history suddenly deposits rupees 9 lakh in cash and immediately transfers it to a foreign account. Even though it does not cross the rupees 10 lakh threshold, the transaction is suspicious due to the sudden behavior change. The bank can file a suspicious transaction report based on their judgment. Fourth, distinctibility of various reports. Different types of reports serve different purposes based on the nature of the transaction. Example: CTR helps in identifying large cash-based transactions that could indicate money laundering. STR highlights transactions that look suspicious based on behavior or activity patterns. CCR focuses on detecting counterfeit money circulation. Each report type is distinct and serves a specific surveillance function for the FIU. B. Cash Transaction Reports PCT. First, integrally connected transactions. Transactions that are connected in such a way that they should be viewed together must be reported if they cross the threshold. Example: a person deposits rupees 6 lakh at branch A and rupees 4 lakh at branch B on the same day. Though the deposits happen at different branches, they are integrally connected, making the total 10 lakh rupees, which triggers the CTR reporting requirement. Second, transaction between internal accounts. Movements of funds between accounts of the same customer within the same bank can also be reported if deemed suspicious. Example: a customer transfers 8 lakh rupees from their savings account to their business account and then withdraws the same amount in cash. Though these transactions happen within the same bank, if the pattern looks unusual, the bank may file a CTR or STR. Branch-wise reports. Transactions reported on a branch level must be aggregated across all branches to ensure compliance. A customer deposits rupees 5 lakh at the Delhi branch and rupees 7 lakh at the Mumbai branch within a week. The bank must aggregate these deposits, which exceed 10 lakh rupees in total, and file a branch-wise CTR. See other rule-based reports. First, Non-Profit Organization Transaction Report. Non-profit organizations are often targets for illicit financial activity, which is why their high-value transactions must be reported. Example: a non-NGO organization receives rupees 25 lakh from foreign donors in a single transaction. The bank must file an NTR to ensure the funds are not being used for unlawful activities such as terrorism financing. Second, Cross-Border Wire Transfer Report (CBTR). Cross-import transactions exceeding a certain value are reported to ensure compliance with anti-money laundering regulations. Example: a company sends rupees 75 lakh to a business partner overseas. Since this is a cross-censure transaction exceeding the specified threshold, the bank must file a CBTR. Third, Counterfeit Currency Report (CCR). Reports for counterfeit currency or forged securities must be filed when detected by a bank. 1. Reporting counterfeit notes. Example: a customer presents rupees 1 lakh in cash for deposit, but rupees 200,000 is found to be counterfeit. The bank must file a CCR detailing the amount of fake currency detected. 2. Fake valuable security forged document. Example: a customer submits a forged bond as collateral for a loan. The bank detects the forgery during verification and files a CCR reporting the fake security. D. Suspicious Transaction Reports (STR). First, Suspicious Transaction Reports Rule 2. Suspicion can arise from any irregular behavior or transaction that appears unusual. Example: a customer who usually deposits small amounts suddenly starts making multiple high-value transfers. The bank may file an STR under Rule 2H because of the change in the customer's transaction behavior. Second is Suspicious Transaction Reports Rule 2G. If a transaction seems inconsistent with the customer's usual business profile, it can trigger suspicion. Example: a grocery store owner who typically deals in small amounts suddenly deposits rupees 50 lakh in cash. This irregular activity compared to the business's usual pattern can trigger an STR filing. These reporting mechanisms are essential tools for financial institutions to detect, report, and prevent illegal activities like money laundering, fraud, and terrorism financing. They help safeguard the financial system by ensuring transparency and accountability. And so we have completed this chapter of part 1 of transaction monitoring and reporting. In the next lecture, we will see its part 2. We will learn about transaction monitoring and reporting. If you want to get update of this topic, then please press bell icon of this. Thank you so much for watching this video.